Right, good morning everybody. I believe we are up and running. So we're going to get going. My guest this week is Alexander Darwall, who's the manager of European Opportunities Trust. But as usual, before we talk to him, I'm going to run through some news, and you'll be unsurprised to know that most of that is about Saba. So if we could just move on to the first slide, please. There we go. Cool. And keep going. Keep going. So yeah. So most of it's about Saba. Then we go about ground rents. So Saba first. Obviously, on the 18th of December, we had 7 requisitions. Each of them proposed sacking the entire board of the trust. And then Saba put forward 2 new directors for each trust, one of which works for itself, and the other one it has nominated. And its plan is to serve notice to the existing managers, get itself proposed as the new manager, adopt what it calls its closed-end fund strategy approach, which it says investors consistently call for. I have no idea of one investor who's called for this, but apparently they reckon it's a thing. And they will provide options to provide substantial liquidity, but without giving much detail of what that means, and then merge everything that they control into one trust. So, looking at the next slide. This just shows you the state of play as of this morning. You can see that the discounts on these funds are quite tight now. One of them is actually trading at premium. And what we're talking about here is an attack on assets of about £4 billion, so a sizable chunk of the UK investment companies industry. The next slide. Looking at the stakes, this is what it held in these funds at the 18th of December. And one of the reasons why the discounts are narrow is it's been very aggressively buying this stock. So even past the point where normal people would be sort of holding back. And that's what's driven the discounts in. And so really it's using these big stakes to try and force through its agenda. And we think it's relying on the idea that it will vote and most of you won't. But I think we've been riling people up enough to change that situation. So we look at the next slide. This is the justification it gave for why it picked these funds. So it said these are quite wide 3-year average discounts, and these are fairly poor relative returns compared to the benchmark. But if we look at the next slide, obviously, as I said this morning, already the discounts have narrowed. Several of these are doing things that I think mean those discounts will be permanently narrowed. And then on the performance things, they've been really slightly duplicitous, I think, in the way that they've gone about this. So they've picked a time period and some statistics that suit their agenda. So really, they've targeted funds that are cyclically out of favour. And one of these is obviously US growth, but that's already turning, and it was one of the best performing trusts last year. They've picked a couple of funds where they've already indicated we know it's not working and we're going to provide you a cash exit. So that's Keystone and Henderson Opportunities. Edinburgh Worldwide 2 we think is already turning around, but they are still planning to return £130 million worth of capital. And then with City Natural Resources, they used the wrong index, so they compared it to the world energy sector instead of the metals and mining index, and then the 3-year period disguises sort of hides all of the good performance of City Natural prior to that period, so it's well ahead of indices. And then with Herald, they used the Russell 2000 rather than the Deutsche Numis small cap, which is Herald's other comparator. It's important to note that Herald's US investments have beaten the Russell 2000, but because the US investments have done so well relative to everything else, it didn't beat the Russell 2000 across the whole fund. But then that's not its remit, that's not what it's designed to do. Anyway, so moving on. And this just sort of summarises where the performance numbers are as of this morning. And you can see Betty Gifford's very strong recent numbers in there. And you can also see some very good 5-year numbers for some of these funds, particularly the first couple. Moving on. So, in terms of how this has played out, Herald became the first trust to publish a circular on the 3rd of January. The meeting scheduled for the 22nd, and it will be the first of these meetings. So, it's the first kind of test of this, whether it's going to be objected or not. Now, it's very important if you are planning to vote, and we do hope you are all planning to vote, the votes have to be lodged by the 20th of January. But if you're voting through a platform, the deadline's liable to be much earlier than that. Herald mentioned in its circular that it's delivered 865% in NAV since Saba started in April 2009. And that's important because Saba responded to that with a different figure. And it highlighted the lack of detail in Saba's proposals, and also tried to draw investors' attention to the dangers of abandoning small cap tech at this point in the cycle, just as it's getting particularly exciting. And they listed a whole list of things that they're investing in that they're quite excited about. On the same day, Enron Wide said there was a problem with what Saba's had lodged, and that meant that reset the timetable for that trust, so it will end up holding the last meeting of these 7. Moving on. On the 6th, we had betting for US growth response. So they noted that investors have almost tripled their money since IPO, which plays to this thing about the cherry picking the stats. And they were worried that Saba's proposal would mean value destruction, particularly around what would happen to its unlisted investments, which is a relatively large part of that portfolio. And they also highlighted the fact that their ongoing charges ratio is quite low, about 0.7%. And if you look at the next slide, you can see that. Move on. This is from the front page of the closed-end fund that Saba is proposing to replace these existing trusts. And there on the right-hand side, you can see its fees. So its management fee is 1.1%. The other expenses that you'd add together to get the ongoing charges ratio in the UK would add another 1.39, so that's 2.5%. But because there's look-through fees on the funds as well, the whole operating expense is 5.8. And obviously, we've been trying very hard not to get people to look at these fund of funds look-throughs. But we believe this might be relevant here. We don't know for sure. But it is possible that Saba holds some funds that it also manages that also pay it fees, and therefore there would be a doubling up. So I mean, you can see how outrageous this is, and how there's no way in hell that you could launch a fund in the UK with those sorts of numbers and expect to raise any money. Moving on. Keystone were very upset because they've been trying to talk to Saba all the way through this, and they knew they wanted to provide liquidity to investors. And Saba were rebuffing them and not really talking to them. So they put together a plan. They spent a decent amount of shareholders' money putting that together, getting that published. And if that is blocked, then they will be extremely upset about that. And they noted that the Saba proposal, one of the directors would likely be overboarded, and I think that's a real problem. And the other nominee doesn't really have any relevant experience, and that goes across the piece really, that their nominees don't have enough experience of UK investment trusts to make it a sensible approach. And on the next slide, the following day CQS Natural Resources came back and said, well, hang on a minute, we already do annual continuation votes, we don't really see why this is necessary, but we've been thinking for some time about what we can do to narrow our discount, and we've got a whole raft of things that we're looking at, and we'll tell you what they are by the end of June. One of these is a possible merger with another trust of the same remit, and that's because they're too small. I'd like to see it grow by itself, but we'll just have to see whether that's possible or not down the line. And on the next slide, European smaller companies, really highlighting the fact that this is not a good time to be getting out of European smaller companies, and I think Alexander probably has some strong views on this as well. But they're going to introduce a 3-yearly performance conditional tender offer. The first of those would be in June 2028. It wouldn't have been triggered for a while because its performance has been very good, as we've said. And then on the next slide, Enskilda Opportunities, we've talked about they're going to offer a cash exit. They were putting together the plans, but they hadn't got them announced before this all happened. It's going to be a cash and a rollover into an open-ended fund. And they wanted to stress that Saba's proposals don't give you any assurance that they will provide you with a cash exit, or how much that will be, or what kind of discount you are going to end up experiencing on that as well. So they're going to wait, I think, until after the Saba vote, and then, assuming that they win, publish the circular for this proposal shortly afterwards, and then you will be able to get your cash out in March. And then on the next page, there was a row yesterday around Saba saying that it would give Herald investors a 100% cash exit at 99% of NAV. Two things that were sort of picked up on there. One is that it really illustrates the fact that it thinks that once it's got its nominees and they're in charge, it will be able to tell them what to do, and that will happen. Because in the real world, if you had an independent board, which is what they say they're going to have, then there'd be a real chance that the board would say that wasn't a good idea, and maybe we don't want to do something else. But they sort of seem to be saying that they think they can tell the board what to do, and I think the FCA should have a look at that, to be honest. And then, secondly, Herald said, the thing about this is you are going to exit, but it won't come for at least a year, and the NAV that you end up getting would be extremely afflicted by the fact that people will just see them succumbing and adjust the prices accordingly. So not great. And I would, with all of these things, if it came to winding these things up for cash, the existing managers are a much better place to do this than Saba would be. And then on the next page, just coming back to Keystone again. So that EGM for its scheme is on the 17th of January. It needs 75% approval. Obviously, Saba's going to have to block that. I think, though, that shareholders will be very upset if that's what happened, and we're going to have to wait and see what happens at that vote. There was an issue, we have discussed this before on the show. I didn't like the scheme because it would the cash exit is a 1% discount to NAV, but there is a way that you can get full cash for your shares if you roll into the open-ended fund and then immediately redeem them. And then on the next page. So this is really the key message from all of this. We think this is a terrible idea across the board. And it's not just us saying this because we want to try and present the sector. These really proposals fall down on a number of fronts. So make sure you do vote. Don't miss the deadlines. Don't think, well, I've only got a few shares, my vote doesn't count. It really does count. Sometimes the margins on these things are very slim. But more importantly, I think the more convincingly that it's defeated, the more likely it is that it will just retreat and leave us alone, because this is extremely unhelpful for the development of investment companies sector going forward. So that's Saba. One brief mention then of ground rents income. There's the chart, pretty dreadful. Really started falling off a cliff in 2017. There were all sorts of issues around one of the big buildings that it had owned the ground rents on, and it was exposed to repairs that needed to be done there. But as the story progressed, it became more and more about the fact that people didn't like the whole freehold leasehold structure in the UK and the way that ground rents were structured. And the government made lots of noises about sort of tackling that, regulating the sector, banning these structures. So ground rents have adopted a wind down approach for a while now. And if we look on the next page, that happened in April 2023. They've only sold £11 million worth of investment so far. Looking at the opportunity, thinking about the fact that probably shareholders are quite frustrated at the pace of this outfit called Victoria Property Holdings has submitted offers to Grio. The board didn't engage, rejected the offers, and so now they've gone public. They haven't actually upped the price that they were offering. But it's really just a question of whether you want to take cash now or sit around and wait for the wind down strategy to happen, which Victoria are saying could take years. So on the next page, it's a big premium to where the share price was trading at. So 34p is 48.5% premium to the prevailing share price. But it's still quite a big discount to the NAV. It gives value to the company at 32.5 million. It's a cash deal. They could do it tomorrow if the board says yes. And this is only sort of an indicative offer. So it has until the 5th of February to decide whether it's going to make that firm or not. So it's talking to its advisors and shareholders. That will issue a new NAV quite soon. I'd be surprised if that wasn't down again. And so it's going to be used into acting, but I think we'd probably like to see the back of this. We'll have to wait and see what shareholders say to the board. So that is enough from me. Now, if we could talk to Alexander, and we could ask him. There he is. Good morning. So as usual, I'm going to ask you to sort of tell us a bit about European Opportunities and the investment approach and how it all works, please. So I'm going to hand over to you.
Okay, thank you very much. Let's move on to the next slide. I was going to tell you a bit about great. Consistent investors. So what I say today is what I've been saying for years, and all being well, it's what I'm going to be telling you for quite a few years more. So throughout this, what we say is what you get. Consistent investors. This is the team. A little bit more on the team on the next slide, please. This is the investment team. I mean, worth noting, and I'll come on to more of it detail in a moment, this is a bigger, better team than I've ever had before. I worked as a one-man band a long time ago. Then Luca came to join me about 15 years ago. So we have a much, much better quality team than ever before. And that, taking us on to the next slide, was one of the big motivations. If we just look at the next slide, please, about setting up Devon Equity Management. I call it superior culture for better outcomes. And basically, we moved out of the mainstream, setting up on the side like this, and we did it precisely because we could get, we believed, much, much better focus. I mean, our only remit is trying to get good returns for clients. We have no other agenda. We have a very experienced chairman to help us, but we have a dedicated CEO in Richard Pavry, who we worked with at our previous place for many years. So he does all the necessary compliance and organizes back office and all these things, which means that I'm spending far more time on investment than ever before. So we have none of the distractions of the mainstream, and I think that helps a great deal in giving us focus. Now, the superior culture I talk about, where we have a complete focus of trying to work well for you and get good returns for you with none of the distractions of the mainstream, is meant to lead to better outcomes. I believe it will, but I'm going to come back on to performance in a minute because it's not delivered in the short term, quite obviously. But if we just look at the next slide, please, I want to show you it has been a successful long-term strategy. I'll come back to the short term, but it has been good for a long term. I've been doing this for about 30 years. This particular fund, the investment trust, in its two guises, the Jupiter European Investment Trust, and it rolled over into what is now the European Opportunities. So we know what we're doing. We've been doing it for a long time. I'm going to move on to the next slide, please. Differentiated approach. So we operate outside the mainstream. We think for ourselves. We are totally focused on trying to get the best outcomes for shareholders. That's who we work for, none of the government agencies or anyone else. We have this remit and this remit only. And we do it through investing in special companies. And I want to spend just a moment on telling you what I think a special company is. We want companies that have, in a certain sense, a bit of an unfair advantage. And that could be through embedded databases. It could be through a technology. And the proof of it being special is having higher margins for longer, higher growth and higher margins for longer than you might reasonably expect. Because these companies are not particularly vulnerable to competition. And these companies are not really in the sights of the regulator. So they're operating sort of below the radar of the regulator, and new entrants find it very difficult to compete with them. These tend to be high intellectual property companies with high margins. And we try and find them in as many different areas as possible. So it is not simply, as you might possibly imagine, a technology healthcare portfolio. We've got a lot of different exposures, but generally speaking, free pricing and able to exercise their pricing power. So I put at the bottom here, the bottom line of this is measurable, monetizable, and collectible. That's to say, we prefer companies who can deliver products and services, the benefits of which are measurable for their clients, and the pricing power is such that our companies can monetize their good offer, and they can indeed collect the money. And that all that means is it pushes us a bit more to the world of B2B. So these are business and government staples, if you like. And I'll take it only because it's our biggest holding as an example, but Novo Nordisk, which is a world leader in the treatment of diabetes and indeed obesity, they can measure through clinical trials the benefit they give. They can monetize it because healthcare authorities are generally rational and you pay for what you get. And it's collectible because for the most part, they're well underwritten by government programs and by corporate healthcare plans for the most part, though that's changing slightly with the obesity because there's a lot of out of pocket. But here is an example where we have products delivered, measurable, monetizable, and collectible. So these special companies, this collection of special companies, as I call them, should deliver good returns over time. I think we'll move on to the next slide, please. And I just want to explain why we think these special companies are winners. And that's because there are plenty of disruptive threats that we look at, or potentially disruptive threats, such as regulation, technology changes, and changing consumer habits. And the first thing we do when we screen for companies is to see how they're affected on the downside. What is the downside risk from changes in regulation, from new disruptive technologies, and thereby changing consumer habits? And only when we think we've got a good understanding of that do we turn it around and say, well, are these companies winners from those potential disruptions? Is there upside from this? And so as a result of this, I think in many of our companies are in fact disruptors. And again, just because it's the biggest holding, I'll take the example of Novo Nordisk. Novo Nordisk has historically been a leader with one American competitor, and also another European competitor historically, a leader in the treatment of diabetes. But they've been doing it, if you like, in late stage diabetes. That's when you need insulin. But there was a whole area of pre-diabetic area where the oral anti-diabetic drugs were applicable, and the DPP-4s and such like, Januvia and these kind of drugs. So there was a whole half of the market that was not addressed by companies like Novo who treat diabetes through insulin, the pre-insulin phase. And they've disrupted because they brought in the GLP-1 class of drug. And they are, with GLP-1 drugs, now addressing that half of the market that's pre-insulin. So we now, it's effectively disrupting because it's taking on and taking market share in the pre-insulin phase of the diabetic journey. But they still have a strong position in the insulin part of the diabetic journey. So here is a good example. We didn't see new technologies disrupting their insulin franchise because it's still a really important part of treating diabetics at that stage of the disease. But the part of the cascade in which they weren't present before, the pre-insulin phase, they are now addressing with GLP-1 drugs. So they are disrupting that half of the the potential market they didn't have before. They've effectively doubled their total addressable market with these new class of drugs where they and one other are a leader. So that's a good example of what I mean by looking at potential disruption and seeing, are we winners or losers from it? I want to pick up one other point on this slide, and it's to explain in part short-term poor performance and to explain why I think we can deliver for you soon. But I think there are two main reasons why we've had poor recent performance. And one is that we've always been looking to identify structural winners through the cycle. And we haven't had a proper cycle. We've had an extended and extraordinary cycle in as much as with QE, Western governments flooded the market with money, kept interest rates artificially low, and they kept basically a lot of companies that should have struggled, they kept them going. This was a foolish thing to do, and it meant that a lot of second-rate companies kept going. And where we believe we have an advantage, we have really strong, highly profitable companies, and they don't get the benefit of that. Or to put it another way, our companies have much less debt or cash, much less debt than the average. So flooding the market with money to help their debt problems wasn't relevant for our companies. So I think it's fair to say that if you look at our strategy, and I'll come on to an important piece of it, which is our global coverage, we've seen the financial sector in Europe doing particularly well. The very thing I think shouldn't have done so well, the mainstream European banks, a play on Europe, has performed very well because of this QE policy. So that's one thing. I'd like to move on to the next slide, please. The second factor that we've seen, and James alluded to it, is there's been a big move from active to passive management, which is very obvious in Europe. And this plays more to the benefit of the mega cap. And so if we just go on to the next slide again, please, you'll see combined with the move to passives and mega cap, there's also been money coming out of Europe. And these two factors have cost us because we are a sort of a no cap size fund. We're happy to invest in mega, big, mid and small cap, but we have much, much less in the mega cap than you can find in the mainstream ETFs. So we've found another way of saying it is than smaller, but even mid and even some of the bigger cap companies have been left high and dry by a complete lack of interest from global investors and this fund flow going out of Europe. There's undoubtedly been funds going out of Europe, and I think the smaller the cap, the more vulnerable you are to that. And we've got some excellent companies where valuations are too low because of this fund flow phenomenon. Next slide, please. Just in terms of what we offer high return on capital employed. Yes, there's a higher PE, and I'll come on to that, but these are much more profitable companies and with much stronger growth prospects than the average. And I'll give you some more detail on that when we come to valuation of the portfolio. On the next slide, please, you will see an important part of this is that Europe has been a structurally low growth area. Yeah, it's in decline. And our strategy for dealing with this has always been to seek global winners. There are some great European companies operating globally. You'll see in a minute just how much we have, how much exposure we have to the faster growing parts of the world. We've got lots. We have companies whose strategies are vindicated by global success. So this fund is not a play on Europe, never has been. It's a play on great European companies. Next slide, please. Global exposure. Yeah, we do have some exposure to Europe through our companies, but you can see 34% in North America, and then emerging markets 20%, Japan and Australia. We have a very big exposure to other parts of the world, and even Deutsche Börse, which is probably deemed to be the biggest play on Europe, is actually not the case. It's a global interest rate derivatives play but it's all done through their German exchanges. But it's a way of saying that we seek to have global leaders, and I think this gives us a very good way of mitigating the fact that Europe's in structural decline. Next slide, please. I take AI as a bit of an example because everyone asks about it, but it comes with a lot of challenges, AI. Of course, it can disrupt existing business models, but actually we think we have a bunch of companies which are winners from this. The obvious ones are the ones with a lot of their own proprietary data, so they can monetize what they have already, and AI helps them do that. So here's a really good example where we talk about potential technology disruption. We don't see it as a risk to our businesses because they're high value proprietary data businesses. The people who will suffer are much more, well, labor can suffer from this, but also the substitution effect, but also companies, it's like call centers and so forth, are far more vulnerable to this kind of challenge. We don't have that kind of business. We, on the other hand, have businesses who own the data and they can monetize it better with the help of this technology. Moreover, there are some infrastructure plays, and we have Infineon, Prysmian, and Besi, which are beneficiaries from the need for more AI, which is basically higher quality data centers. Next slide, please. I mentioned it a minute ago. We think our fund is the cheapest it's been since 2017. We have high growth rates in our companies. The valuation premium has come right down. I don't see an uplift in European economies as being the route to success here. I don't think necessarily that I can forecast a quick change in the funds flow. I think PE will have more will have more role to play because the markets aren't functioning efficiently here. But I think the idea, which is propounded by many, that you simply buy an S&P ETF, these strategies never work forever. There will be a turning point, and our best protection and our best strategy is to make sure we've got some very high quality, world-beating companies in our portfolio, and capital will find them in due course. So the next slide, final slide, before your questions, if I may. We're very committed to this strategy. We haven't changed it. We're consistent investors, focusing on special companies. These are companies which can grow longer and stronger and have, as I describe it, an unfair advantage. Our portfolio is the cheapest it's been since the index since 2017. We are very resilient to any macro slowdown. We have less debt than the average. That's, I'm talking at the company, at our investee company level. Our companies have stronger balance sheets, less debt. They're more global, and they have more B2B and business to government, and I take Novo Nordisk as an example of that, and less consumer exposure than the average. So I think we're extremely well positioned for all eventualities, and we will continue to work hard for you to deliver performance. So thank you. With that, James, I'd love to have some questions.
Good. For some reason I couldn't turn my mic on. There we are. Yeah, I think we're there now. So thank you very much indeed, Alexander. I think it's very interesting. And just a couple of sort of structural things. So how much turnover is there within the portfolio? Let's do that one first.
I wish I had some help from Luca on this one, who's not on the call, who would tell you to greater detail than I can. But I think, roughly speaking, we sell in a normal year about 15% of the portfolio and buy another 15. It's distorted by unusual events, but essentially, if you like, I'm making 3 mistakes a year, big mistakes a year of 5% positions, and we sell and we're buying another. So it's a low turnover fund.
Fair enough. And when you're looking for a new stock, have you got a sort of list of things that are sort of bubbling under that you're interested in and thinking, if that was a little bit cheaper, I'd buy it, or if this happened, I'd buy it?
We have a long list of things we're happy to own and that we would buy. Generally speaking, it's when things go wrong that we're prompted to sell, and that is the moment of replacement. I'm reluctant to invest in what I think is a really excellent company and get a bit bored with it and sell it. This would be a mistake. And some of our best investments have repaid us because of our patience. I take Dassault Systèmes as an example. It's out of fashion currently, but we've owned it since June 1996. That's when we first invested. So we've had it a long time. It's been an amazing growth story. I think it remains an amazing growth story. But in that time, we've had some disappointing patches. But to sell it and to know exactly when to go back in, that's more difficult. So we spend less time on market timing and sentiment of other investors and trying to gauge when sentiment changes. We spend much more time trying to get the fundamentals right. And if we think we've got a special situation, a special company, we tend to stick with it. So it's only when we recognize I've made a mistake, that's really what's causing turnover. Of course, there are examples where we trim positions to free up cash to buy something new that we like. That of course happens too. But I don't think it's the main driver of success or failure.
And the sorts of companies that you're looking at, are they always large companies, or do you go again sort of mid cap, small cap?
No, we're fairly agnostic about the size of company. I don't think the size of a company determines how good it is. What determines how good it is a business characteristic. So we have less in the mega cap space. I think you would call Novo Nordisk, the obvious mega cap holding. We are down the size scale compared with the average fund. This is more of a mid cap fund. We have a few smaller holdings, small cap holdings, but not many. So what we like is we want proven, established business models with a big addressable market, a global market. So that takes us away from venture capital typically. It takes us away from loss-making startups. It takes us away from very small companies because we need to see a record and see they're established. So if they're still very small, something might have changed, so we might be interested. And we'll push down the size scale because we like companies with real focus, which sort of matches our culture, if you like, rather than getting diverted into becoming a conglomerate. We like companies who are very, very focused. So we tend to end up, we're getting pushed down the size scale by the need for focus, and we get pushed up the size scale by the need for established, successful, proven concepts. So we end up somewhere more in the middle than the average. And this, as I say, has been a problem because when funds come out of Europe, and they have come out of Europe, there's no doubt about that, the global investors have completely lost interest and think there's nothing in Europe. We think we've got some great companies, but Europe's out of fashion. You might have spotted that.
Yeah, indeed. One of the things that's differentiated about European Opportunities is actually because it's a pan-European fund. So why include the UK within the remit?
There are things there's nothing I like about the UK economy compared with European economies. So please don't believe that for one moment. That's never been the case. It's just that we're kind of size agnostic and actually country of listing agnostic also. We've got one or two UK holdings which we couldn't get any other way, which are very good on the global scale. Look, in the past, when everyone loved this fund, gosh, I can remember, it's a few years ago now, but I mean, it did happen. Everyone said to me, why don't you move the global space? I said, well, I've got plenty to do here. So allowing me to have a small presence in the UK market or interest in the UK market is hardly losing focus on what we're doing by going global. But I just don't see it as it's not a different thing at all. It's just not different.
Fair enough. Do you worry about currency moves when you're looking at the portfolio, or is that just a sort of byproduct of what happens with the investing?
So there are a couple of, maybe three reasons why I don't worry about currency. We need to understand it and be aware. one is we're certainly not in the business of forecasting currency. That would be a very, very risky thing to do. So what are we going to do? We're not going to come up with a better currency outlook than other people. So there's not much point in looking. It's worth understanding it, but not forecasting it. Secondly, because we have a much more global coverage, it's so much more complicated. We might have companies. I mean, we've got companies who've got a big exposure in Brazil, for example, but they've also got a big exposure in the US and in the UK. I mean, Eden is big in France. Its second biggest market is Brazil. So I think we mitigate the currency risk in part by being more globally spread. And the third reason is the types of companies we've got are typically those with pricing power, where yes, there's a translational effect from currencies, but not a transaction effect. To put it another way, if you took a sort of a pure commodity thing like a Scandinavian pulp producer, currency is everything to them. You're a hero or zero depending on what the level of dollar is against the Swedish crown or something. That's not what we want, because then it's really what you're doing is you need to be a currency forecaster. So we are in high value added, high margin, global plays where there's less price sensitivity. We offer, moreover, we might have companies whose cost base and revenue base are much more closely correlated. Cannot be the case with, say, the Scandinavian pulp maker, because their cost base is absolutely where it is capital intensive, it's fixed. Whereas if you're more in the business of high value proprietary data, or in the case of Dassault Systèmes software CAD/CAM, you can match your costs with your revenue currencies much more easily. Novo Nordisk, of course, is producing for the US market. It produces in the US. So there are a number of sort of natural mitigations, which means that we don't need to spend time on currencies generally.
Fair enough, that makes sense. Which kind of leads us into politics. I understand that obviously companies can keep producing profits and keep making sales regardless of what's going on in sort of political rows. But obviously tariffs and things like that do have an influence, and also policy around, healthcare, for example. So in particular, thinking about Trump and the US US administration, do you think that's going to have any impact on your portfolio?
Well, I don't know what Trump will do. The message changes that as they say, don't take him literally, but do take him seriously. So I don't know. What I can say is that we don't have direct exposure to things like car manufacturing. So stuff about electric vehicle tariffs, whether it's in Europe, where the tariffs are going up for the Chinese producers, or in the those kind of headlines are largely irrelevant to us. Tariffs are not normally applied on, as far as I know, on things like Dassault Systèmes CAD/CAM. This is sort of software packages going down the wire. I don't really see how the tariff thing would affect that. Again, high value added, IP, data driven things, much less vulnerable than capital intensive fixed asset steel businesses or car business. This is a much more difficult area from a tariff point of view, or agriculture, soft commodities. So I don't see us as being in the firing line for that.
Fair enough. And there's a couple of stock specific questions. Maybe we can have a look at some of those. Do you hold LVMH, and if not, why not?
We don't hold LVMH, and obviously, as we only hold about 33 holdings, I think we could have a very, very long conversation about what we don't hold and why not. But in the case of LVMH, I mean, look, it's amazing and interesting that the richest man in Europe is in luxury goods, and the richest man in America is doing sort of high tech and amazing, extraordinary things. It tells you a lot about the difference between Europe and the US, that we're making high quality handbags, and that's how you get rich, on leather handbags. We don't, partly because, as I said earlier, we're in a sense, playing it safe, and it's been wrong to play it safe, but I think it now comes back into focus much, much more now, is that we are in measurable, monetizable and collectible, and we're more in the B2B space. And just by way of example, Novo Nordisk clinical trials, they can show they got a better drug for someone. That's not the case with a handbag. So we think that discretionary spend, which I know there's a much bigger problem in Europe than there is in Asia, but it's not something we've sought to do. And again, if we come back to the offer of this fund, we're not so much in the mega cap. We are trying to find some special companies that have been overlooked by the market, particularly as Europe's been so out of favour.
Yeah, exactly. What's the attraction of Deutsche Börse? I think that the question is asking relative to, is it a better company than LSE, for example?
I mean, look, of course, it's a good question, but it's an irrelevant. I mean, they can both be good. They can both be good. They can both be bad. I mean, we don't see it. They're doing different things. I think it's perfectly acceptable to own both of them without saying one is better than the other. They're not really competing very much. LSE's gone a slightly different route. I think Deutsche Börse has spent more money, and I think they're investing more in trying to get the exchange businesses right, because they think, partly because of AI and blockchain and moving to cloud, they think they have the opportunity to capture more liquidity pools over time with superior infrastructure. LSE, with its Refinitiv acquisition, has gone more the data route. So they're going slightly different strategies, and I don't think we need to spend too much time. I think they can both be good.
Fair enough, makes sense. And then the last one is Infineon. So are European semiconductor companies competitive relative to Asian ones?
Yes. If you look at so Infineon, the simple case for Infineon, it is the world leader in power semiconductors, and power semiconductors are all about the more efficient use of electricity or power in car. And as we move to more electric, whether it's in cars or in data centers or transmission, the greater efficiency you have with the help of power semiconductors, the better. And just the proof of this is they gained market. They continued to gain market share. And 2024 was a very good example. They won more than their fair share of design wins in the Chinese electric vehicle power semiconductor MCU market. They gained share, design wins in China last year. That tells you they are good at it. They are good. They're good. Now, you could say long term, well, the Chinese are going to be the best in the world in everything in due course. Well, fine. But if that's the case, they'll still be the rest of the world for Infineon. But as it happens, they are the best globally for now, and they're the best in Asia in power semiconductors. Infineon's a very impressive company.
Great.
In a growth area, because
Yeah.
the need for power semiconductors is growing rapidly, not only, but in the near term, mainly in the electric vehicle space. But it's not just there, it's data centers as well. There are a whole bunch of, the move to electrification absolutely plays to Infineon's strengths.
Good, thank you. Probably sort of one last thing. So Johnny said there's a question about how you control your discount, but actually I can link it to one that came in right at the beginning, which is what was your experience of dealing with Saba? Because obviously before all of this happened, they got involved within European Opportunities, and I believe don't hold it anymore. But can you tell us a bit about that?
Well, I can't really, because I don't know very much about it. The board does all that stuff, and
Yeah.
Richard Pabry does all that stuff. We're very focused on trying to get the investment right, and I leave the corporate stuff. The board does all that. We just need a bit of patience, though it is clearly turning our way. But we need a bit of patience for some of these great European holdings we've got to attract more capital and get the valuations they deserve. I think these slightly tougher economic conditions, interest rates are staying slightly higher for longer than people thought, which is not a surprise to us because inflation is an extremely intractable problem. And Europe and UK policies are necessary, where they make the cost of doing business much higher all the time. It is an inflationary thing. So with tougher economic conditions, I think our portfolio looks better, and I think my focus is on that. So I'm not strong on the corporate side. I think others can give you much better answers.
Okay, fair enough. Well, thank you very much indeed, Ozan. I think we covered a lot of ground. I think we've answered most of the questions. So, and I know there's a question here about, do you hold stock in the trust? I know that's definitely true. You're a big investor. But
yep, I've got a lot of shares. I mean, look, I mean, all that says is, I'm absolutely passionate about what I'm doing. I've more than put my money where my mouth is on this. I'm absolutely committed. That's no guarantee of success. It's a guarantee that I care a lot, but it's not a guarantee of success. I accept that, but no one can question do we want it to succeed, because I've just seen that question sort of flash. Yeah, I've got a lot of shares.
Exactly. Good.
Yeah.
All right. Thank you very much indeed.
Thank you.
And
thanks, James.
We'll talk to you again in a year or so, but good luck with it in the meantime.
Thank you, James. Thanks. Bye.
Great. There's a legal warning. Please do read. And then we should look at next week. So next Friday is indeed the first of those votes, the Keystone vote. But well, it's not a vote on the Saba thing, but vote on their scheme. Remember that. So, but I don't think we're going to have any news of that by the time the show comes out. But because of the situation, what we've done is we've tried to free up some slots and talk to as many of these companies as possible. So we're going to kick off with a conversation with Gary Robinson, who's the manager of Baillie Gifford US Growth, next week. I'm hoping we're going to get another one on the 24th of January. And then on the 31st of January, we're going to be talking to Emerald Worldwide, which, as I say, is the last meeting out there. So I think, given the constraints around how long it takes to vote, that might be the last one we can squeeze in, but we'll see how we go. So thank you very much indeed for your time today, and I will see you next Friday.